There's a tax deduction worth up to $6,000 a person, on the books through 2028, and most retirees over 65 are leaving it on the table. If you're 65 or older, or you're helping a parent who is, this is money you can claim, but almost nobody does. Not because they don't qualify, most do. It's easy to miss, and no one tells you it's there. In the next few minutes, I'll show you what it is, who gets it, how much it's really worth at your income, and honestly, who it won't help, so you're not counting on money that isn't coming. And stay to the end. The last tip can win it back even if you think you earned too much. Let's start with what it actually is. Back in 2025, a tax law came through. You may have heard it called the One Big Beautiful Bill. Among a lot of other things, it created a brand new deduction just for people age 65 and older. Here's the simple version. A deduction lowers the amount of your income that gets taxed. It is not a check in the mail, and it's not a credit. It's a reduction in your taxable income. This particular one is worth up to $6,000 per person. And I want to underline per person, because this is where couples win. If you're married and both of you are 65 or older, you can each claim it. That's up to $12,000 off your taxable income as a couple. One more thing to know up front. This is temporary. It's on the books for tax years 2025 through 2028. After that, it goes away unless Congress extends it. So this is a 4-year window, which is exactly why it's worth understanding now. So who actually gets this? There are 3 rules, and they're refreshingly simple. Rule 1, age. You have to be 65 or older by the last day of the tax year, December 31st. And here's a nice detail. You do not have to be collecting Social Security to claim it. Being 65 is enough. Rule 2, you need a valid Social Security number. For most of you watching, that's a non-issue. Rule 3, if you're married, you have to file a joint return. Married couples who file separately don't get it. So if you and your spouse are both 65 or older, filing jointly is what unlocks the full $12,000. And now the rule that makes a lot of people happy. You can claim this whether or not you itemize. If you take the standard deduction, like most retirees do, you still get this. If you itemize because of big medical bills or mortgage interest, you still get this. It works either way. That's unusual, and it's good news. Now here's the piece that even some tax preparers get wrong, so pay attention to this part. This $6,000 does not replace the deductions you already have. It stacks on top of them. Think of it as 3 layers. Layer 1 is your regular standard deduction, the baseline everybody gets. Layer 2 is the extra standard deduction that seniors 65 and older have already gotten for years. And Layer 3 is this new $6,000 deduction. You get all 3. They add together. I'm pointing this out because the single most common mistake I see is someone assuming the new deduction is their senior break, that it replaced the old one. It doesn't. It's an additional layer. So if your tax software or your preparer only applied one, that's worth a second look. Okay, here's the catch. And I promised you the honest version, so here it is. This deduction phases out at higher incomes. It is not unlimited. The number that matters is your modified adjusted gross income, your MAGI. For almost everyone watching, that's just your adjusted gross income, the figure on line 11 of your tax return. Don't overthink it. If your MAGI is at or below $75,000 as a single filer or $150,000 as a couple, you get the full deduction. Above that, it starts shrinking by 6 cents for every dollar you go over, and it disappears completely at $175,000 for singles or $250,000 for couples. Let me make that real with an example. Say you're single, 65, with a MAGI of $85,000. That's $10,000 over the threshold. 6% of $10,000 is $600. So instead of the full $6,000, you'd get $5,400. Still very much worth having, just reduced. So the full deduction is for low and middle income retirees, a partial one for the upper middle range, and nothing once you're comfortably into 6 figures. Know which bucket you're in before you count on it. Now, I want to do something most videos won't, and tell you who this won't help. Because I'd rather you know the truth than be disappointed at tax time. First, as we just covered, higher income retirees above those top thresholds get nothing from it. That's by design. But here's the one that catches people off guard. Some lower income seniors won't benefit either, and not because they don't qualify, but because they don't need it. Here's why. A deduction only helps if you have taxable income for it to reduce. If your income is low enough that you already owe little or no federal income tax, which is the case for a lot of folks living mainly on Social Security, then an extra deduction doesn't put money back in your pocket. There's nothing left to deduct it against. So this deduction is most valuable for seniors in the middle. Enough income to owe some tax, but not so much that you've phased out. If that's you, this is real money. If you're at the very bottom or the very top, it may do little or nothing. That's just the honest math, and I'd rather you hear it from me. Let's get practical. How do you actually claim this? The good news is, it's not complicated. For 2025, this deduction is claimed on a new form called Schedule 1A. That's the schedule for the additional deductions that came out of the 2025 law. If you use tax software, it should walk you through it with a simple question about your age. If you use a preparer, this is the moment to ask one direct question. Did you include the new senior deduction on Schedule 1A? And is it stacked on top of my standard deduction? Those two things. Asking out loud is how you make sure it actually got applied. And keep it simple. You don't need to do anything fancy, you don't need to itemize, and you don't need special paperwork beyond confirming your age and your income. The system is set up to give this to you. You just have to make sure the box gets checked. Here's the tip I promised at the start, and it's for anyone sitting just inside that phase-out range. Say, a magi in the high 70s or low 80s as a single filer. Remember, the deduction shrinks based on your income. So if you can lower your income for the year, even a little, you can sometimes win back a chunk of the deduction. One common, legitimate way retirees do this. If you're old enough to be taking required withdrawals from a retirement account, you can direct some of that money straight to a charity through what's called a qualified charitable distribution. That gift doesn't count as income to you, which can pull your MAGI back down and restore part of the deduction. I'm not telling you to do that today. I'm telling you it exists so that if you're right on the edge, you know there's a lever to pull. And it's worth a conversation with a tax professional before year-end, not in April when it's too late. So here's what to do. First, figure out roughly where your income falls, so you know whether you're getting the full deduction, a partial one, or none. Second, if someone else prepares your taxes, ask them the two questions I gave you. Third, if you're near that phase-out line, look into lowering your income before December 31st, because once the year closes, that door closes too. To make this easy, I put together a free one-page checklist. The senior deductions most retirees miss, including this one, with the income limits and the deadlines laid out simply. It's free, the link's in the description. Download it, and if you're helping a parent with their taxes, send it their way too. One important note, this is educational, not personal tax advice. The rules depend on your specific situation, and tax law can change. So before you file, confirm your details with a tax professional or at irs.gov. I'm Jeffrey Miller. My goal here is simple. Straight answers about your retirement money. No panic and no pitch. If this helped, subscribe, and I'll see you in the next one. Take care.